Momentum works differently in stocks and crypto. In US equities, classic time series and cross-sectional momentum thrive on 6 to 12-month cycles. In crypto, momentum decays in weeks, volatility is 3 to 5 times higher, and cross-sectional signals often reverse. This episode dissects why, and how to adapt the engineering. Start with the equity baseline. Academic research, notably Jagadish and Titman and later AQR, identifies a 12 to 7-month formation period, look back 12 months, skip the most recent month, as the most robust for cross-sectional momentum. For time series momentum, multi-window signals from 1, 3, and 12 months are standard. The equity market's long cycles, low shorting costs, deep liquidity, and daily closing hours make these classic frameworks directly applicable. But factor decay is real, driven by crowding and regime shifts, so we need dynamic weighting and state-dependent exposure. For instance, when many investors pile into the same momentum trades, the edge diminishes. Regime shifts, such as changes in monetary policy or economic cycles, can also alter the effectiveness of momentum. Therefore, a static momentum strategy may underperform over time, necessitating adaptive mechanisms that adjust position sizes based on current market conditions. The soul of TSMOM is volatility scaling. You scale your position by the ratio of a target annualized volatility to your current estimated volatility. When volatility spikes, you reduce exposure; when it calms, you increase it. This time-varying risk budget is the main source of TSMOM's superior risk-adjusted returns, as shown by Moskowitz, Uwe, and Peterson. In equities, target around 10 to 15% annualized. In crypto, target 40 to 60% to avoid excessive leverage. The mechanism is straightforward. By targeting a constant volatility, you avoid large drawdowns during turbulent periods and capture more upside during calm trends. For example, if the current volatility is 20% and your target is 10%, you would have your position. This dynamic adjustment ensures that the strategy's risk profile remains consistent over time, which is critical for compounding returns. Crypto is a different climate. Momentum cycles are short, around 30 days, and cross-sectional momentum often fails or reverses. The market trades 24/7, volatility is 3 to 5 times that of stocks, and shorting is expensive and risky. Empirical work on 8 major coins from 2020 to 2025 shows time series momentum using multi-period EMAs delivered 31.96% annualized, beating cross-sectional momentum. But single windows underperform multi-period fusion. The first principle: never bet on one window, blend multiple periods. The reason is that different market regimes favor different look-back lengths. Short windows capture recent trends, while long windows capture persistent ones. By combining them, you get a more robust signal that adapts to changing conditions. For instance, during a rapid bull run, a 30-day window might signal a buy, while a 180-day window might still be negative if the trend is new. Blending them reduces false signals. A practical multi-window signal combines several look-back periods, each contributing a sign. For crypto, you might use 180, 90, and 30 days with weights favoring the slower cycle. For equities, use 261, 65, and 22 days. The signal is a weighted sum of the signs of past returns. This ensemble adapts to different market regimes. Short windows catch recent trends, long windows capture persistent ones. The weighting scheme can be optimized based on historical performance, but a simple equal weight or inverse volatility weight often works well. For example, if the 30-day return is positive, the 90-day return is negative, and the 180-day return is positive, the weighted sum might be positive if the 180-day weight is higher. This approach reduces the impact of short-term noise and provides a smoother signal. Compare TSMOM parameters across markets. Equities use 22/65/261-day windows, target 10 to 15% volatility, and estimate with 60-day standard deviation or Yangzhang. Crypto uses 6-hour to 1-day frequency, targets 40 to 60% volatility, and often uses ATR or stochastic volatility models. The crisis behavior also differs. Equities TSMOM provides crisis alpha, while crypto needs flash crash protection. In equities, momentum tends to perform well during market crashes as investors flee to safety, but in crypto, flash crashes can occur within minutes, wiping out positions before risk management can react. Therefore, crypto TSMOM must incorporate circuit breakers or trailing stops to limit losses during extreme events. Additionally, the higher target volatility in crypto reflects the higher risk appetite of crypto investors, but it also requires more precise volatility estimation to avoid over-leveraging. In 2025, crypto CTAs shifted from classic monthly TSMOM to adaptive trend frameworks. They use 6-hour signals to balance accuracy and costs, introduce an alpha factor for ATR-based volatility adjustment, and a lambda for long-short allocation. Backtests from 2022 to 2024 show a Sharpe of 2.41 and max drawdown of -12.7%, beating buy and hold Bitcoin. Dynamic trailing stops helped avoid multiple flash crashes in 2025. The adaptive framework adjusts the signal frequency and position sizing based on market conditions. For example, during high volatility, the alpha factor reduces position size, while during low volatility, it increases. The lambda parameter controls the aggressiveness of the long-short allocation, allowing the strategy to be net long in bull markets and net short in bear markets. This flexibility is crucial in crypto, where trends can reverse abruptly. A volatility filter dramatically improves momentum performance. For Bitcoin from 2017 to 2024, adding a 30-day realized volatility cap at 80% annualized boosted annual returns from 156% to 198%, cut max drawdown from -71% to -38%, and improved Sharpe from 1.12 to 1.84. The filter kept the strategy in cash during the three major crashes of 2021 and 2022. The mechanism is simple. When volatility exceeds the cap, the strategy exits the market, avoiding the sharp downturns that often accompany high volatility. This is particularly effective in crypto, where volatility spikes often precede crashes. By staying in cash during these periods, the strategy preserves capital and reduces drawdowns, leading to higher risk-adjusted returns. The filter also reduces the frequency of trading, lowering transaction costs. Crypto introduces unique engineering challenges. 24/7 trading creates weekend effects. Momentum strategies perform better on weekends, especially in small-cap altcoins. September is the weakest month, averaging -4.7%. Flash crashes can wipe out order book depth by 98% and widen spreads from 0.20 to 5.92 basis points, a 30-fold increase. Traditional TSMOM can blow up in such microstructure collapses. Also, momentum profitability is heavily skewed to the long leg. Losers can explode on short squeezes, making cross-sectional shorting dangerous. For example, a short squeeze can force short sellers to cover at rapidly rising prices, causing massive losses. Therefore, crypto momentum strategies must incorporate safeguards such as limit orders, stop losses, and avoiding shorting illiquid coins. Additionally, the weekend effect suggests that momentum signals may be stronger when traditional markets are closed, as crypto trading volume and volatility patterns differ. Cross-sectional momentum forms portfolios based on past returns. In equities, use a 6 to 12-month formation period, skip the last month, sort stocks monthly, and go long the top decile, short the bottom decile. In crypto, the formation period is only about 30 days, and signals decay quickly. Daily ranking with top 20% long and bottom 20% short is common. But the evidence is mixed. In a 143-coin sample, winner-minus-loser returns were near zero and insignificant, sometimes negative. The reason is that crypto markets are less efficient and more prone to reversals, especially over short horizons. Additionally, the high correlation among cryptocurrencies means that the long and short legs are not well diversified, reducing the spread. Therefore, cross-sectional momentum in crypto requires careful selection of the universe and formation period, as well as robust risk management to avoid catastrophic losses from short squeezes. To make XSMOM work in crypto, you must adapt. Use a short formation period of about 30 days, daily ranking, and top/bottom 20% portfolios. Delta neutrality is essential. The long-short structure is naturally market neutral, but you need rebalancing thresholds to control costs. Liquidity filtering is crucial. Most returns come from the top 40 coins by market cap. State filters reduce exposure in low-sentiment regimes. A simple systematic momentum strategy can achieve 249% returns with 82% lower volatility than the broad market, but that's cherry-picked. Naked cross-sectional momentum can see drawdowns over 55% due to high correlation. For example, during a market-wide sell-off, both winners and losers drop, causing the long-short portfolio to lose on both sides. Therefore, incorporating a market filter that reduces exposure during downturns can mitigate this risk. Additionally, rebalancing thresholds prevent excessive trading, which is important given the high transaction costs in crypto. Here's a comparison of decay defenses across markets. Volatility scaling automatically adjusts risk budgets, fighting decay. Multi-period ensembles adapt to regime changes. State machine filters, like volatility thresholds, keep you out of crashes. Cost models must be honest. Crypto round-trip costs exceed 0.2%, and a strategy with 15% gross return can turn negative after costs. Finally, overfitting defense requires at least 100 trades per parameter, which is hard with Bitcoin's short history. For example, if you have 5 parameters and 500 trades, you have 100 trades per parameter, which is borderline. With fewer trades, the risk of overfitting increases. Therefore, it's essential to use robust parameter estimation techniques and out-of-sample testing. Additionally, incorporating a cost model that accounts for slippage and fees is crucial for realistic performance evaluation. To sum up, classic momentum frameworks transfer from equities to crypto, but only with major re-engineering. In crypto, use short windows, volatility scaling with high targets, and delta-neutral structures. Always apply liquidity filters and state-based crash protection. Be brutally honest about costs and overfitting. The evidence is clear. Multi-window fusion and volatility scaling are the core of robust TSMOM, while crypto XSMOM demands careful adaptation and risk controls. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.